Friday, November 20th, 2020, Maneco 64, home of alternative economics and contrarian views. So last year in July 2019, I did a video entitled, "In Times of Monetary Upheaval, Hard Assets Will Protect Your Wealth." And I stick to that. How did I know we'd have the monetary upheaval we're having this year? And what do I mean by monetary upheaval? Well, it's the increase in the central bank's balance sheets, all the money printing. Since then, the Federal Reserve is doubled its balance sheet. The Bank of England also almost doubled it. The ECB as well is increasing its balance sheet massively. All central banks around the world. The other central bank we saw a few weeks ago was the Reserve Bank of Australia. And how could I forecast that we're going to have monetary mayhem? Did I have a crystal ball that saw the crisis we had this year? No, it's just trying to learn from history and trying to project or speculate in what could happen, and learning from history that once a certain course of action is taken by monetary and governmental authorities, that course of action is doomed to fail unless they stop it. And one of the best books that taught me about the monetary aspect of things, the inflationary aspect, and yes, many people don't think we have inflation, but we do have monetary and credit inflation. I mean, we've had it in spades, especially since the '08 crisis. The central banks and the governments, they had to throw everything at the system, or else their fiat currency system, which is supposed to be a lot better than a system of sound money, right, would have collapsed. And they always blamed the gold standard, of course, for the Great Depression, but it wasn't the gold standard that caused the Great Depression. It was the fact that the Federal Reserve Bank of New York inflated the system inordinately in order to keep the pound overvalued versus gold, because the United Kingdom went back on the gold standard after World War I at the same rate that it was before World War I, and it should have gone at a higher exchange. And that's what really caused all the speculation, all the easy money, the roaring 20s in the US. It wasn't gold. It was the bad monetary policy, inflating and then deflating, right? That's what it led to. And that's the book here. I really recommend it. You can find a free PDF online, Fiat Money, Inflation in France, How It Came, What It Brought, and How It Ended by Andrew Dixon White. It's not long, and it's a great book because it not only talks about what the French elite, the French National Assembly did in terms of issuing the assignats, and also continue to issue it. They were skeptical before issuing it because they knew the troubles of money out of thin air from the Mississippi bubble about 80 years before. But it led to disaster as well, this experiment. It took about 6 years. Now I think our current experiment is taking longer because everyone's at it. Back then it was only French, so I highly recommend you read that. So why am I bringing this up today? Well, because we've got a couple of people here, one especially who I don't know much about. I've heard of him, John Malone. So he's a multi-billionaire American businessman, so one of the richest men in the world, I would say. And CNBC reported here, John Malone says he's buying hard assets like housing in bet on currency devaluation. So there you go. That's what happened when central banks and governments issue too much money and credit, when central banks create all the reserves to monetize government borrowing, especially when the economies are moribund like they are now because of the crisis. And even before the crisis, we were seeing countries slow down. China, at the tail end of 2019, their GDP growth was the lowest in 30 years. UK, quote-unquote GDP was going negative already. So, yeah, this crisis exacerbated that, but it was going to happen anyway. So the other thing that you learn from this book is, like I said, once you start printing money, you can't stop it. You could stop it, but it will bring everything down. So they have no choice. It's inflate or die, as the old saying goes. So let's quickly go through this article on CNBC. I'll put a link to this article as well in the description, and you can listen to what he says. They have a clip of just under 3 minutes here. It says, Liberty Media chairman John Malone told CNBC that hard assets look attractive as the unprecedented coronavirus stimulus is poised to lead to a depreciation in currencies. Yeah, they're going to say that it's all because of coronavirus, but I would argue that they're using that as an excuse. If it wasn't the coronavirus, there would have been another crisis to give them the excuse to continue to print. And anyway, they started printing in September last year already because of the repo crisis. The Fed increased its balance sheets by 500 billion from September to just before they really accelerated in March. So this is what he says. We've survived this because of enormous fiscal and monetary stimulus, Malone said in an interview that aired Thursday with Squawk on the Street co-host David Faber, or Faber, if you want to pronounce it in correctly, as the Germans would. And I've got to believe this will lead to devaluation of currencies, that hard assets will increase in value in currency terms. So there you go. The more currency you create out of thin air, in abundance, it's very hard, though, to conjure up hard assets like land and other things. We haven't yet found out how to do that, and I don't think we ever will, of course. And he says, I'm not sure I'm going to call this inflation, but it'll look like and feel like inflation. I'm not sure why he's saying that. Maybe because he knows that the government is going to keep lying about the CPI. And still, a lot of people think that CPI is really like indicative of inflation. So let's keep going. To support the economy through the pandemic, the Federal Reserve slashed interest rates to near zero and vowed to keep buying assets under its quantitative easing measures. Lawmakers passed a historic $2 trillion relief deal in March. Okay, so let's have a look at what he's been buying. So this is what he says. I've been trying to invest and diversify into hard assets, Malone said. You know, I think things I bought this last year, I bought substantial interest in multifamily housing, primarily in the US. He says, I bought irrigated farms because commodities were cheap and farms were at a low cycle in value. And I'd always wanted to have some irrigated farming. So now I'm growing potatoes. So of course, very few of us can do what he does, diversifying like that. But it gives you an idea what these people are doing, the very wealthy. Yeah, I'm sure he didn't have to take a mortgage on those real estate properties that he bought. And as I've said, yeah, real estate will do well as well during a currency devaluation. And he didn't even mention hyperinflation, but you will see in the little clip that the guys from CNBC actually said it's almost like he's expecting hyperinflation, but he didn't use the term hyper. So he didn't mention gold and silver, but I think for us mere mortals who aren't billionaires, silver is a good bet. It is quite hard, isn't it? Hard asset. Gold as well, of course. and other things. You have to use your imagination, just like Mr. Malone did. And then you have Ray Dalio, who we know is got probably one of the biggest hedge funds, runs one of the biggest hedge funds out there. He's been into gold already, but yesterday there's another article here. Investing legend Ray Dalio tells investors to not own bonds or cash. And I've said that because as the currencies devalue and even get close to hyperinflating, bonds are just like a cash. It's just a cash loan extended through time. That's all bonds are. So if the dollar depreciates versus hard assets versus gold, U.S. treasuries are not going to do well, especially when they're keeping interest rates manipulated at almost zero. You're getting no return for your cash, even long term. That's all bonds are. Bonds are just cash that you lend over the long term. So let's quickly see the headlines here from this article. I won't go through it. Don't want to take too long. I'll put another link to this one below as well. It says Ray Dalio told investors to not own bonds or cash in an interview at Bloomberg News Economy Forum on Tuesday. The Bridgewater Associates founder explained that central bank policy has changed the economics of borrowing. In my opinion, don't own bonds and don't own cash because they're producing a lot of debt and producing a lot of money to fund it. And so that's changing the nature of capital flows. He told investors to diversify between currencies, asset classes, and countries because it's the best way to reduce risk without reducing opportunity. He didn't mention hard assets or other things like gold and silver, like Mr. Malone mentioned hard assets. I think we can assume that he means more hard assets and commodities. He says that you should diversify between countries as well. I think countries that have a lot of natural resources could be interesting as well. I'm not here to tell you where to put your money. I'm just giving you the strategy that these guys have. And these are two of the richest men in the US or arguably in the world as well. So there you go. That's why hard assets are so important. And I've shown you this chart several times before here of how commodities are so undervalued still versus the stock market. It's the most in like 120 years. So I think these guys know this. They have their advisors. They've got time on their hands as well to do their own research. After all, they've got a lot of wealth to protect. I mean, when you've got IMF and other central bankers talking about a new Bretton Woods conference, you know that there's trouble in the currency market. You know there's trouble in the monetary system. You had Putin last year as well, late last year, after I made this video, say that the dollar was very near to collapsing. So there you go. Let's quickly look at where the markets are this morning. It's 8:47 a.m. London. Precious metals still having a tough time. Yes, it's frustrating, but yeah, we gotta. Do you really want to get out of hard assets? Well, maybe you might be selling your gold and silver to Mr. Malone or Mr. Dalio. We'll have to. You have to decide. So we got gold at 1866.70 right now. It's up $1. So the range has been 1860 to 1870. So pretty narrow range. Silver, yes, got hit hard yesterday. It's recovered back up. It's 24.20 right now, up 16 cents or 2/3%. The Dow future is down 100 points, 1/3%. S&P is down 11, 1/3 as well. The NASDAQ 100 future is virtually unchanged. Currency markets, sterling is unchanged, 132.60. Euro is down slightly, 118.68. Dollar is unchanged versus the yen, 103.83. The dollar yuan, dollar's down about 1/8% at 656.60. WTI crude is trading at $42, unchanged. So markets are fairly quiet right now, I would say, except for the stock market is down slightly. Precious metals are pretty much unchanged. Silver is outperforming a little bit. To finish off, let's look at the 10-year yield or the bond market. The 10-year yield has been dropping in the last week or so. We got up to almost 1%, and right now we're down to 0.84. That means that people are buying treasuries or buying bonds. It doesn't really equate to what Ray Dalio is saying, but as I've said many times before, this is short-term noise. These guys think in the long term, and I think he's going to be proven right. And even if bond prices don't move much over the long term, the fact that the dollar depreciates and we see currency devaluation and we see very little returns in terms of real returns in these bonds, they're not going to really protect your wealth. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Parler, and all these other platforms below here. I wish you all a great day. Take care. Bye.